Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Rocket Lab.
If you find our talks useful, please consider subscribe, like, and comment underneath. And definitely check out the VIP Algos link below in the description.
Yeah, that VIP Algos tool is just incredibly helpful for spotting the exact kind of market shifts we are going to break down today.
Exactly. So, usually when we think about building wealth through critical infrastructure, we picture things we can physically touch.
Right, like massive concrete highways.
Yeah, highways or, heavy steel power grids cutting through a mountain. You can literally drive past them and see exactly where the investment dollars went.
It's all entirely terrestrial, grounded and very tangible.
But today, we are looking at an infrastructure project that you cannot drive past, because the most critical wealth-generating infrastructure of our era isn't being built in a canyon. It is being built in low Earth orbit.
Which is just a monumental paradigm shift in global economics. I mean, we are looking at a commercialization of space that has moved completely past the government science project phase.
Oh, absolutely.
It is directly into a ruthless industrial economics phase now. And the companies building it aren't just laying tracks, They are building the trains, owning the cargo, and controlling the stations.
And that brings us to the core of today's analysis. We are unpacking a company sitting at an absolute defining inflection point here in mid-2026, Rocket Lab.
Right.
If you're listening to this and you're even remotely curious about the modern space economy and those massive wealth-building implications we mentioned, you really have to understand what is happening with this specific stock right now.
Because the setup here is fascinating. Markets have a notoriously difficult time pricing extreme growth alongside extreme risks.
Yeah, they really do.
And Rocket Lab is basically the ultimate case study of that tension right now. They are no longer just some plucky startup trying to get small rockets off a launch pad.
No, they are attempting to transition into a vertically integrated end-to-end space infrastructure powerhouse. So let's start with the hard fundamental numbers, because the inflection point coming out of Q1 2026 is, frankly, screaming for attention.
The numbers are wild.
They really are. They reported revenue of $200.35 million. That is a 63.4% year-over-year explosion.
Wow.
Yeah, and they decisively beat the Wall Street estimates of $189.65 million. But, the revenue beat is really only half the story here.
Right, because the more compelling metric is actually the composition of that revenue. The traditional expectation for a space company is that they are just a launch provider.
Like a highly explosive delivery service.
Exactly. You pay them to put a box in space, they put the box in space, and the transaction is over. But Rocket Lab is seeing a massive structural improvement in their margin profile because of their space systems division.
And just to clarify, that's the division that actually builds the satellites, the internal components, and the software running them.
Right. That's the one. And that changes the entire economic model. Launching rockets is a really high-risk logistics business. It's heavily dependent on weather, on hardware survival. But building satellite components, writing software to operate constellations, creating standardized satellite platforms, that is a manufacturing and recurring software business.
Which carries significantly better profit margins.
Way better margins than just, assembling and expending rocket fuel.
And when you look at the future demand for that manufacturing, they currently have a record backlog of $2.2 billion.
$2.2 billion.
Yeah, which has literally doubled year over year. And for you listening, an aerospace backlog isn't just a casual wait list or a sign-up sheet. It represents contracted agreements and milestone payments.
It basically acts as an insurance policy on future revenue. It gives them exceptional revenue visibility for the next several years.
So why is their backlog doubling while some of their competitors are struggling?
It comes down to their competitive moat. Specifically, their strategy of vertical integration. A prime example is their acquisition of a company called Solero.
Okay, tell us about Solero.
Well, in space, power is everything. By bringing Solero in-house, Rocket Lab suddenly controls a massive share of the high-efficiency space grid solar cells used across the entire aerospace industry.
Oh, wow. So they aren't just calling up a supplier to buy parts for their satellites.
No, they own the supplier. They capture the profit margin that a legacy aerospace giant would normally just bleed out to a third-party vendor.
They're capturing every margin layer.
Every single one. And they are leveraging that specific in-house capability to deeply entrench themselves in national security contracts,
Right.
like the Space-Based Interceptor program and their partnership with Endural for the HASTE hypersonic launch program.
Let's pause on that hypersonic thing. Why does vertical integration make them the go-to for a hypersonic weapons test?
It's about speed of iteration and security. If the DoD needs a highly classified, experimental hypersonic vehicle launched, they do not want the prime contractor waiting on a supply chain of 40 different sub-vendors spread across the globe.
That makes sense.
Yeah.
Too many leaks, too many delays.
Exactly. Rocket Lab can build the launch vehicle, manufacture the satellite bus, provide the solely power, and write the flight software entirely under one roof.
So the switching costs for the government become prohibitively high. They can't just easily swap Rocket Lab out for another vendor.
Right.
So if I'm conceptualizing this correctly, it really is the Apple ecosystem model, but applied to zero gravity.
That is a great way to look at it.
Like, Apple doesn't just want to sell you a piece of glass and metal. They want you using their proprietary software, subscribing to Apple Music, storing your life on iCloud. Rocket Lab wants to do the exact same thing for Orbit.
Yes, it's a closed-loop economic engine. The more services a customer uses, the harder it is to ever leave the ecosystem.
But here is where I have to push back hard on this really rosy fundamental picture.
Okay, let's hear it.
Apple makes a profit, a massive, world-beating profit. Capturing all these margin layers sounds fantastic in theory, but when I look at the actual financials for Rocket Lab, they are bleeding cash.
They're definitely spending heavily.
They have heavy negative free cash flow. They are taking an absolute beating on GAAP earnings per share, which, for those tracking at home, is the strict accounting method that heavily penalizes upfront research and development.
Right.
If this vertical integration mode is so incredible, why are the financial statements just a sea of red ink?
And that tension is exactly what makes the current valuation so heavily debated. From management's perspective, the negative free cash flow is not a structural flaw. It is a deliberate cyclical phase of aggressive investment.
They are pouring capital into R&D.
A staggering amount of it, specifically for their new Neutron rocket and scaling the manufacturing footprint for that space systems infrastructure.
And they have the cash to do this.
They currently have the liquidity on their balance sheet to fund this expansion without immediately diluting shareholders by issuing massive amounts of new stock.
Okay, so they're choosing not to hoard cash or buy back shares.
Right. Every spare dollar is being aggressively reinvested into high-return growth avenues, like the new Archimedes engine and specialized landing barges for rocket recovery. They accept accounting losses today to secure total infrastructure dominance tomorrow.
Right, so the core business fundamentals are accelerating, the backlog is record high, revenue is crushing estimates, and the losses are a calculated investment.
Yes.
If you are an investor looking purely at those metrics, you'd assume the stock chart is a straight line up and to the right. But this is where the technicals and sentiment get really interesting.
Extremely interesting.
Back in May 2026, the stock hit a 52-week high of $150.23, but recently it cratered. It dropped all the way back down into the $109 to $114 range. Why the massive disconnect?
That brings us directly to market psychology, and specifically the SpaceX effect.
Ah, the SpaceX IPO.
Exactly. SpaceX recently held its long-awaited IPO, debuting at $175 a share. The heavyweight champion finally entered the public ring.
And that crushed the competition's stock prices.
It triggered a massive sell-the-news event across the entire space sector. It heavily rocked rivals and pulled down valuations across the board.
But let's break down the mechanics of that. Is this a sign that investors suddenly discovered a fatal flaw in Rocket Lab? Let me use an analogy here.
Sure.
Let's say you are a portfolio manager and you own a massive position in Pepsi stock because it's the best beverage company you can buy. Then suddenly Coca-Cola finally goes public.
Okay.
You don't sell your Pepsi shares because people magically stop drinking Pepsi overnight. You sell Pepsi because you have a finite amount of money and you desperately need cash to buy Coke shares to balance your portfolio.
Yeah.
Is that mechanical rotation what happened here?
That portfolio repositioning is exactly how the institutional analyst community is framing this dip. When a massive whale like SpaceX enters the indices, large institutional funds are mathematically forced to reallocate capital.
So it's a rotation of liquidity, not a referendum on Rocket Lab.
Precisely. And we can see tangible proof of this in how Wall Street analysts are reacting. They are aggressively framing this specific pullback as a buying opportunity.
Yeah, the upgrades are rolling in heavily. KeyBank upgraded them to an overweight rating with a $135 price target.
Which is a very bullish signal.
Right. And just to clarify, an overweight rating is essentially an analyst telling portfolio managers, you should hold more of this specific stock than your benchmark index dictates because we think it will outperform.
Stifel also raised their target to $132, and Clear Street bumped theirs to $129.
And out of 18 analysts actively covering the stock, 14 rated a buy. 0 sell ratings. 0.
Furthermore, the technical setup shows the stock forming a very constructive psychological bottom following that sell-off.
Where's the support?
There is strong technical support near that $109.25 level, meaning buyers consistently step in there. The immediate resistance, the ceiling it needs to break through, sits at $122.50.
Okay, so if volume pushes it through that resistance, it opens the door to previous highs around 134 or 143.
Exactly.
But I have to bring up a glaring red flag here. We have all these analysts pounding the table, but there's been significant insider selling recently.
That is true.
Go back to my Coke and Pepsi analogy. If the analysts are so confident this is just a false dip, why are Rocket Lab executives selling their own shares? Do they know something we don't?
Insider selling always warrants intense scrutiny, definitely. However, looking at the structural mechanics of executive compensation, you have to separate routine automated selling from actual panic selling.
Like selling for taxes.
Exactly. Insiders frequently sell shares to cover massive tax obligations when stock options vest, or they sell in pre-scheduled automated plans, 10b5-1 plans, designed specifically to avoid insider trading accusations.
And the stock had a massive run-up prior to May, so that triggers those plans.
Right. It's a point of caution, but it hasn't deterred the broader institutional buying flow. That $2 billion backlog doesn't disappear just because a VP diversified their personal portfolio.
Fair point. So sentiment is shifting back to bullish. But a stock needs a specific event to actually move. It needs a catalyst.
The market operates entirely on cause and effect, and Rocket Lab has a highly specific, impending mechanical cause marked on the calendar.
June 22nd, 2026. Rocket Lab is officially being included in the NASDAQ 100 index.
This is a huge deal.
For anyone listening who isn't a market mechanic, I like to think of index inclusion like a college athlete getting drafted into a major pro sports league. Before, you had to hustle and convince every single fan to buy your jersey individually. But once you get drafted, a percentage of every single ticket sold at the stadium goes to you automatically, whether you played a great game that day or not.
That is a highly accurate comparison. This inclusion forces hundreds of billions of dollars in index tracking funds and passive ETFs to accumulate Rocket Lab stock.
It's not a discretionary choice.
No, it's a strict legal mandate. If a mutual fund tracks the NASDAQ 100, their computers must blindly buy Rocket Lab shares. It establishes a completely new, higher floor of permanent institutional ownership.
And beyond that mechanical buying, there are massive speculative catalysts brewing. Rumors of a $700 million Mars telecommunications orbiter contract.
$700 million for a single mission architecture.
Plus, rumors of integrating their tech into Raytheon's highly classified Golden Dome defense architecture.
And while those are unconfirmed rumors, they are backed by an undeniable macroeconomic tailwind. We are looking at a proposed U.S. defense budget of $1.07 trillion.
And how much of that is for space?
$56 billion is earmarked specifically for space-based systems, nearly double the historical funding levels.
$56 billion. Okay, but I have to challenge this premise. Yes, the pie is huge, but SpaceX is the undisputed king of that pie. Rocket Lab is the clear number 2. Realistically, how much of that budget can the number 2 actually capture? Aren't they just fighting for scraps?
That assumes government procurement works like a normal free market. It doesn't. In national defense, being reliant on a single provider is a critical national security vulnerability.
Oh, because of redundancy.
Exactly. The DoD operates on a fundamental mandate of redundancy. They simply cannot rely solely on SpaceX for every orbital asset.
Because if SpaceX has a launch pad explosion, the whole U.S. defense grid is grounded.
Which is a nightmare scenario they must avoid. So the government actively funds a strong number 2 player to guarantee supply chain survival. Rocket Lab's vertical integration makes them the only other domestic company technically capable of meeting those end-to-end security requirements at scale.
They aren't fighting for scraps. The government is basically handing them a slice to ensure they survive as a counterbalance.
They desperately need them to exist.
Okay, that completely reframes the total addressable market. But let's bring this down to earth, because every bull case has a severe bear case.
And Rocket Lab has a big one.
Right. Capturing that defense money and validating those analyst targets all comes down to one incredibly complex high-wire act scheduled for Q4 2026.
The inaugural launch of the new Neutron rocket.
This is the make-or-break moment. Why is this specific rocket so vital? They already have the Electron rocket. Why does the entire valuation hinge on Neutron?
It's the brutal math of payload economics. Electron is a small lift vehicle, great for small satellites. But the real money defense contracts, mega constellations, absolutely requires a medium lift vehicle.
Which is what Neutron is.
Yes, it's the category-defining reusable rocket that moves them into direct competition for the most lucrative heavy lift contracts globally.
It's the difference between operating local delivery vans and launching massive transoceanic cargo ships.
Exactly. And that scale makes the Q4 launch a critical binary event. Aerospace hardware is profoundly unforgiving. If Neutron succeeds, and specifically if their new Archimedes engine performs as expected, it completely validates their medium lift thesis.
And if it fails?
If it fails, the entire growth narrative gets crushed instantly.
Yeah, and there was already a testing anomaly in January. They resolved it, but it proves rocket development is dangerous. Any schedule slip or testing explosion would be devastating to the share price.
Very devastating.
And that brings us directly to the extreme valuation risk. Right now, this stock trades at roughly 50 times forward price to sales based on fiscal year 2027 estimates.
Which is well above their historical trading average of 40 times sales.
50 times sales, not earnings, sales. Let's use a real estate analogy. Paying 50 times sales is like paying luxury mansion prices for a house that is currently just a blueprint sitting on an architect's desk.
That is a perfect way to look at it.
You are paying for the perfect execution of the future house. If the Q4 launch fails, doesn't that premium valuation instantly collapse? I mean, Goldman Sachs has a highly bearish $76 price target right now.
Your analogy isolates the exact risk Goldman is pricing in. If the blueprint catches fire, the mansion valuation vanishes. A catastrophic hardware failure, or even just a macro rotation away from unprofitable tech, could hit the stock incredibly hard. The downside at 50 times sales is a very steep cliff.
So how does a bullish investor justify holding this stock with that binary event looming?
They justify it by looking at the established floor. That $2.2 billion backlog provides guaranteed cash flow. The rapid margin expansion in space systems proves they are marching toward actual profitability.
And the winner-take-most dynamics of space.
Exactly. The precedent set by SpaceX proves global capital will pay an astronomical premium for total space dominance. Investors pay 50 times sales today because if Neutron succeeds, revenue scales exponentially, and that terrifying multiple compresses very quickly.
It's an incredibly high-stakes game. So let's synthesize the final verdict here. We are looking at an overall rating of 8 out of 10 bullish.
With a strategic multi-year time horizon of 12 to 36 months, this is not a short-term swing trade.
Right. They are transitioning into a premier space infrastructure proxy. You've got the imminent NASDAQ 100 inclusion, massive defense tailwinds, but the true re-rating event depends entirely on the engineering success of Neutron in Q4.
It absolutely requires patient, long-term capital that can stomach aerospace volatility.
Completely agree. Before we wrap up, if you found today's breakdown valuable, please consider subscribe, like, and comment underneath. And do not forget to check out that VIP Algos link in the description below to track these massive institutional flows.
Highly recommend it.
It leaves you with a really profound thought to ponder. We talked about how the Defense Department mandates a second major player for survival. If Rocket Lab's integration successfully entrenches them as the permanent, irreplaceable number 2 in orbit,
we might be witnessing a historic shift in the global balance of aerospace power.
Exactly. Think about the legacy aerospace monopolies. Those massive, slow-moving prime contractors that dominated the last 50 years. If the future is entirely controlled by SpaceX and Rocket Lab, we are looking at the permanent death of those old monopolies.
Are we looking at a future where orbital infrastructure is essentially an inescapable, newly minted duopoly?
It's a striking mathematical possibility. The companies that own the tracks and build the stations in orbit will dictate the global economy for decades. You can't physically drive past this infrastructure, but the wealth it's generating is as real as steel and concrete. Keep your eyes on Q4 and keep your eyes on the skies.